This is to overview the problems from Chapter 13, Exercises. So on January 1st, 2019, Kelly Corporation acquired bonds with a face value of $500,000 for $483,841.79, a price that yields a 10% effective annual interest rate. The bonds carry a 9% stated interest rate, pay interest semi-annually on June 30th and December 31st, and are due December 31st, 2022, and are being held to maturity. Prepare journal entries to record the bonds and the first two interest receipts using straight line method of amortization and effective interest rate method. First thing I'm going to do is start with the given information. So we have a bond face value of 500,000. Oops, 500,000. We have the purchase price of 483,841.79. We have an effective interest rate of 10%. We have a stated interest rate of 9%, and number of periods equals 4 years. It's a 4-year bond times 2 because it pays semi-annually. All right. I'm just going to put this in quotes, semi-annually. All right. So now we're going to make journal entries. And this will be the straight line method of amortization. Okay, so they purchased the bond on 1/1/19. So first thing we're going to do is purchase the bond. So it's held to maturity. So investment in held to maturity debt security for the purchase price. And then we're going to credit cash. Next thing we're going to do is we're going to calculate the interest. So on 6/30/19 is the first interest payment. So the cash for the interest that they receive is the bond face value times the stated interest rate times, it's semi-annually, so 6 divided by 12 or 0.5. So equals, so my bond should be 500,000. There we go. I have an extra zero for some reason. There we go. So equals the bond face value times the stated interest rate times 6 divided by 12, because it's 6 months that they're paying interest on, or 0.5. So that's the cash. Then we need to calculate the amortization. So this bond was purchased at a discount. So I'm going to go back up to the top and I'm going to do bond discount. I'm going to calculate what the actual discount was. The discount was 500 minus what we paid, or 16,158.21. So the way on straight line we would calculate this, we would add it to the investment. So we bought it at a discount, we're going to write it up to bond face value, because that's what we'll get paid out at the end. Investment in held to maturity debt securities. And what we're going to do is we are going to take the bond discount and we're going to divide it by the number of periods, because there's 8 semi-annual interest rates. And that gives us, and the opposite side of this is interest income or revenue, right? So we get some cash, and some of it we got and advance the interest income by getting a discount. Then we're going to do 1231.19. So the cash is going to be the same. The cash is always the bond face value times the stated interest rate times, if it's semi-annually, 0.5. In the straight line method, the investment in held to maturity debt securities, which increases it to where taking care of the bond discount is the same. So the bond discount divided by the 8 periods. So the journal entries are going to be the same on this. And then it's interest income. We're going to add these two together. So that's the straight line method. I'll highlight this dark so you can tell. Then we're going to do effective interest rate method. Okay. Okay, so the effective interest rate method. So we would purchase the security on 1/1/19 the same way. So it would be investment in held to maturity debt securities. And it would be for the purchase price of $483. And then we would credit cash. Next, on 6/30, this is where the journal entry will differ because now we're using the effective interest rate method. The cash we receive doesn't actually change because the cash is paid on the bond face value times the stated interest rate times 0.5 if it's semi-annually, or the number of months the interest is covering. So now what does change is investment in held to maturity debt security, so how we amortize the bond discount. So this is the effective interest rate method takes the purchase price, and we're going to do this all in equals parentheses purchase price times the effective interest rate times, and it would be 6 divided by 12 or 0.5, and then we are going to subtract what we already recognize for cash. So again, the formula on that is the purchase price times the effective interest rate times 0.5 because it's interest semi-annually minus what we received in cash on this. Now, and then it's interest income. We're going to add this up. So 24,192.09. Now on December 31st, we received the same cash, right? Which is bond face value times stated interest rate times 0.5. Now, the held to maturity situation. So how we're going to write this up. Now we have to take into effect what the actual balance in the investment account is. So investment and held to maturity debt securities. So we're going to equals this. So originally we took the debt security. Now we're going to take what we already recognized plus what we added to the debt security. So that balance, right? So we're going to, so I'm going to get equals 2 parentheses. I'm going to add these two up, the 483 plus the 1,692.09 that we added to it in the first problem. We're going to multiply that by the effective interest rate, multiply that by 0.5, and then we're going to subtract the cash we received. So the interest goes up because we're paying effective interest rate on the balance per se, and we keep increasing the balance by amortizing the discount, and it's interest income. So, and the effective interest rate, it's not straight line. It's going to be more each period. So that's an example of amortizing a bond discount. All right, let's talk about the next problem, 13-3. So on March 31st, 2019, Brody Corporation acquires bonds with a par value of $400,000 for $425,800, a premium. The bonds are due on December 31st, 2024, with a carrying 12% annual interest rate, paying on June 30th and December 31st, being held for maturity. The accrued interest is in the acquisition price of the bonds. So the $425,800 includes accrued interest. So let's put down the given information. Given. We have bond face value, $400,000. We have purchase price, including accrued interest, $425,800. Then we have stated interest rate, 12%. We are going to calculate March 1 fraction. So how much of the year has March 1 happened? That's 3 divided by 12. And then bond premium. How much did we pay? Including the accrued interest. All right. So now we're going to purchase these. So on 3/1/2019, we purchased the bonds. So it's investment in held to maturity debt securities. So we're going to come back to how we calculate that. So we're going to have to calculate the accrued interest first. Accrued interest income. So the interest income is the bond face value times the stated interest rate times the March 1 fraction, or $12,000. So that means the actual bond investment was the 425 minus the 12,000, or 413. So bond premium without accrued interest is 413,800 minus the 400. All right. So now we credit cash. So this is just the journal entry. We paid 425,800. This is a journal entry to purchase. Now we're going to go to June 30th, 2019, the first time we get interest. So now we're amortizing a bond premium. So we're going to receive cash. That's the stated interest rate times the bond face value times semi-annually 0.5. All right. Then we're going to credit. So this is opposite of the last problem. Investment in held to maturity debt securities. And so we're going to amortize the bond premium. And we are going to take the premium and we are going to multiply that by, now it's only 3 months because we already had March. So 3 divided by, there's 66. No. Hold on one second. There's 69 total periods in the bond because it expires in December 31st, 2024. So it's the bond premium times 3 periods that we have it divided by 69 total periods. so $600. And then we are going to credit interest income for the difference. So 24,000 minus the 600 premium that was included in that. And then we get 23,400 in interest income. Okay, let's go to 12/31/2019. So we're going to receive the same cash payment, right, which is 400,000 times the 12% times 0.5 for semi-annual interest. Then we're going to credit investment in held to maturity debt security. And what you're going to do is you're going to take this and you're going to multiply that by 6 divided by 69, or $1,200. And then the difference is the interest income. And that is amortization of a bond premium. And now what we're going to do, so on November 1st, 2018, Reed Corporation acquired a bond with a face value of $700,000 for $673,618.61. The bond carries a stated interest rate of 10%, were purchased with a yield of 11%, pay interest semi-annually on April 30th and October 31st. They were purchased to held to maturity and are due October 31st, 2022. On November 1st, 2019, in contemplation of a major acquisition, the bonds were sold for $700,000. Okay, prepare the journal entries to record the interest receipt and the sale of the bond. Okay, so what we're going to do is we're going to put down given information first. So the first thing is we have a bond face value of $700,000. Then we have purchase price of the bond, $673,618.61. We then have a stated interest rate of 10% and effective interest rate of 11%. First, we're going to make the journal entry to purchase the bond. Journal entry. So we purchased the bond on November 1st, 2018. And it's investment in held to maturity debt securities for the purchase price, credit cash. Okay. Now we're going to make an amortization schedule. So it's Reed Corporation and bond investment interest income and bond discount amortization schedule. This is just a partial, not the whole thing. Effective interest rate method. All right. So that's the title of the schedule. What we're going to do is we're going to have date. This is how you set up the schedule. Cash, debit, interest, income, credit, investment in debt securities, debit, carrying value of debt securities. I'm going to format this so it looks a little better. I'm going to right click, format cells. I'm going to hit alignment and I'm going to wrap text. I'm going to make it bold. I'm going to center it. And that is that. So on 11/1/18, we purchased the bond. So we have a carrying value of the purchase price. Then they pay interest on 4/30 and that would be 2019. So on 4/30/2019, the cash debit is the bond face value times the stated interest rate, and it pays semi-annually, so it's not times 0.5, or 35,000. Now interest income is the purchase price times the effective rate times 6 divided by 12, or 0.5. So interest income is more because we purchased it at a discount. So the increase, or the debit to the investment account, is interest income minus the cash we received, or $2,049. And then the carrying value of the security is the previous carrying value plus whatever the debit is. So now our carrying value is $675, $667, and 63 cents. Now we're going to go on to 10/31/18. Okay. Sorry, 10/31/19. 10/31/19. All right. So the cash is still the same. So bond face value times stated interest rate times 0.5 for semi-annual. Now the interest income is now the carrying value times the effective interest rate times 0.5. Sorry. Shouldn't be the same amount. It should go up. It's the carrying value that was here, so I just touched the wrong cell, times the effective interest rate times 0.5 for semi-annual interest. So now 37,161.72. The increase in the investment security is the interest income minus the cash, and the carrying value is now what it was before, the year before, plus whatever we debited. Now they want us to make journal entries for the interest. So on 4/30/19, it would be cash, which we got from here, investment in held to maturity debt securities, which is what we debited, and credit is interest income. There we are. So now on 10/31/19, we would have cash, which is the cash. We would have investment in held to maturity debt security for that, and the interest income is that. And that is how you make a partial amortization schedule. So the final part of this is the sale of the bond. Which is 11/1/19. So they sold the bond, so they received cash of 700,000. They sold the bond for 700,000. They're going to credit investment in held to maturity debt securities as the carrying value. And then the difference is, since it's on this side, gain on sale of bond. And that is it. You can complete the practice of this, and then there's homework in Cengage.